Major funding for these programs is made possible by grants from Chase Commercial Term Lending and Capital One Bank, New York Community Bank, the Witkoff Group, M&T Bank, Perfect Building Maintenance, Genova Burns, Massey and Webster, Greenberg Traurig, Kilroy Architectural Windows, New York's Window Company. Additional funding is provided by grants from AKA Hotels, Corman Communities, Aerial Property Advisors, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Colliers International NYC, CPEX Real Estate Services, Cushman & Wakefield, Customers Bank, DDG, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, First Nationwide Title Agency, Flushing Bank, Friedman, Gemini Real Estate Advisors, Hap Investment Developers, Herrick Feinstein, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Chairman USRealty.com, John Katsimides, Red Apple Group, Margolin Weiner and Evans, Madison Realty Capital, Massey Knakal Realty Services, Matone Group, Meridian Capital Group, Newmark Grubb Knight Frank, New Banks, People's United Bank, SJP Properties, Sterling & Sterling, Stonehenge Partners, TD Bank, Terra CRG, the CUNY TV Foundation, the Continuum Company, Urban American, and these friends.
You know, these prices are insane. I feel like I'm Crazy Eddie. That's what's going on over here. Land, $1,200, $1,300, $1,400, prices go up. Cap rates, 2, 1, what? Everybody's buying. This is an insane market. But these guys are selling to people. These are the people who are selling the property. So today I've assembled 4 dynamic investment sales executives to provide their insight on these crazy prices. My guests, they include Peter Hauspurg, who is the chairman and CEO of Eastern Consolidated, Glenn Tolchin, who's the executive vice president for JLL New York Capital Markets, Peter Vonderay, first vice president for Marcus and Millichap, and last but not least, AKA the statistician, my friend Bob Knakal, who is the chairman of Massey Knakal Realty Services. 33 years at Easton, 25 years at Massey, let's say 10 to 12 years in the business. You're in about 13, 12 years. Have you seen prices this high?
No. In fact, I thought 2007 was it. I'd retire, and that would have been the peak. But now we are far in excess of 07.
Yeah, Michael, it's never been like this, and I think everybody would agree that from a broker's perspective,
days are here.
Absolutely, from a broker's perspective, the market has never been better. It is really just incredible what's going on right now.
When, as I say to people, and I say this predominantly to people in their 30s, I said, you take your profits, do it like the squirrel. Take the nuts and put them away and hopefully save it for a rainy day. How much longer? I did a show a couple weeks ago and somebody said, there were 7 good years, 7 bad years, and all this. How much longer? I mean, I'm happy for this. It's good for the economy. It's great for the market. But these prices are, as one would say, insane.
Well, Michael, I think we can go a lot further. I think the typical example of a 7-year cycle.
Pills,
we're all eternal optimists, right? To be a broker, you have to be. But if you look at the marketplace, we typically have cycles of 7 years, but you have to remember that from 93 to 2007 was a 14-year run. Prices didn't decrease in the real estate market during the dot-com recession in the early 2000s.
There was 2008, and I remember writing the preface for a book, because there was this investment sales executive by the name of Peter von der Ray who had plenty of time to write a book on the real estate market because there wasn't too much business, correct?
That's correct.
So you had a little slow time for what, 18 months?
Yeah, there was slow time for 18 months, but if you look at what caused that downturn, then you had the banks collapse, the subprime mortgage, the Dow went to 6,000, and that's what caused that slowdown.
Would you say, is there any problem in Iraq and Iran? Are there people who would like to come to America and create another 9/11 if they had the opportunity? Some of these terrorists who publicly said that. Do we have a change? We've had 12 great years with with Mike Bloomberg. We have a new administration. We have other situations. We have questions over there, and we have prices at all-time highs. That it's very difficult that people are paying maybe 40 to 50% of their salary to live in an apartment, right?
It is true that terrorism is always a threat in New York City. It's a new environment in which we live, but we are hopeful that the political environment in which we live in is eradicating and eliminating that threat to the best of their ability. But if you look relatively at New York City compared to other cities around the globe, it is viewed upon as a very safe haven, both politically and economically, and has become much more of a global city than ever, and is a place where foreign investors from across the world want to invest. And that's part of the overabundance of capital that is chasing the investment property that's available for sale today.
Are we only seeing this phenomena in the 5 boroughs? Are we seeing this are we seeing it on the Hudson? Are we seeing it in Jersey City? Are we seeing it in Hoboken? Are we seeing it in Westchester where you live? Okay, or is it is self-confined into these 5 boroughs? Peter?
I would say it's more confined to the 4 boroughs, and certainly Westchester is very slow. Not a lot of depth.
Now, you say 4 boroughs. Certain people would question if the 5th borough is either the Bronx or Staten Island. Which one would you say?
Well, Staten Island seems to have its own community of players, but they don't seem to interact too much with the rest of the crowd in the other 4
because of the bridge and the ferry.
Michael, I think the 5th borough is Miami, actually. But,
is. You're right.
But foreign investors mainly want to be in Manhattan. They've only recently started to go into Brooklyn and to Queens. But primarily foreign investors
What about
want Manhattan
those
property.
Chinese investors who went to Williamsburg over there? You've seen investors. I mean, you're a national firm over there. You have investors who are probably calling from California or other places.
Yeah, we do, and generally, but that's correct. The foreign capital wants to be in Manhattan. You're seeing some of the other hot markets. San Francisco, for example, is reaching peak levels, but in general, we're in a, kind of one of these global city environments, and
Yeah, Michael,
we're cheap from that standpoint.
We brokered the deal to the Chinese government on that Williamsburg site, and that was the first time a foreign entity had purchased a development site outside of Manhattan. So yes, it's happening, but it's not nearly as prevalent as it is in Manhattan.
Do we call Canada when HRE went into Long Island City? That's a borough, okay? They bought the Tishman property, the REIT from Canada. So, they've been into Queens. Queens has also been a market. I mean,
Sure, there's one-offs, but Manhattan is really where they all want to be. If they go outside, it's
but aren't you still selling well in Queens in certain pockets? I mean, Flushing is still moving, doing very well. I mean, Brooklyn is this phenomena that I still remember 5 years ago. You couldn't sell downtown Brooklyn for $80 a foot. Now we're talking $400 a foot. When people say to me, "Oh, I'm on Park Slope," I said, "Don't tell me you're Park Slope. You're Sunset Park." Okay, 3rd Avenue to me is not Park Slope. Okay, but who's buying? Where's the money coming from? I mean, because it's not only the foreign investors. There are a lot of young kids who are the new players. Silver Shore, this one, X, Y, and Z. Right, Peter?
Yeah, you're seeing all groups, but if you look at just when you were talking about foreign capital, some of that is coming through foreign pension funds, foreign family offices. You have domestic family offices here. So it really runs the gamut. And I think you also, from an equity standpoint, you have to look at, what are people's alternatives today? And that's part of what's playing into the mindset of...
You talk about family offices. I don't know if you've seen it. I've seen it. That, a lot of these people who were in the hedge fund business, if you look at it this way, like Mark Lazary, who is, Avenue Capital here, who bought a baseball team. He bought, people are diversing. People who are in the private equity funds are now saying, I want to buy real estate. Mark Rowan was one of the big investors on the Grayson over there. So there are a lot of private equity guys who say, I don't want to have all my money on the Wall Street side. I want to diversify into some real estate.
Yeah, Michael, I think one of the interesting things about the market today is that the demand drivers are very, very broad, and they're all in high gear. If you look at the last 2 or 3 years, you've had the high net worth individuals, the families, the institutional capital, foreign investors. They're all in high gear today, whereas if you look at 2005 to 2011, you had different groups that were most prominent at any particular time. The institutional capital inflated the bubble from 05 to 07, then got out of the market completely. Most of the deals we were all doing from late 07 through 09 were all high net worth individuals and families. Then the foreign investors came in, then the institutional capital reemerged, and today they're all just voraciously looking for properties.
So here is, as I started the program saying, how high can they go? When land prices, let's say one site which is for sale is the Bible Society site, okay, on 62nd, 63rd Street and Broadway. It is a prime site. There is no question it's a prime site. It's near Lincoln Center. It's near 15 CBW. It's a great site. But if it sells for $1,300, $1,400 a foot, the development cost, whoever buys it, with the loss of value. I mean, the break even is going to be mid-twos, right? $2,500.
It's solely a function of how the condominium how the condominium sales market for residential end product is performing, and the average price for a unit in New York City, a new development unit, is $2.1 million. The top end of the luxury market, which is the top 10% of the market, is averaging $2,700 a foot. So when you look at the super luxury component of the market, which are the developments, the 7 or so developments that are surrounding Central Park, and American Bible Society site can likely be considered one of the new entrants, you're really only looking at a number of units that are below a total of 700. So, and a lot of those units have already been absorbed. So you're really not talking about a total absorption that is implausible.
But let's
But
take,
we're also hearing our apartments are cheaper than London and Tokyo and Hong Kong.
That's the truth.
but
yes.
somebody has to be able to afford it. Maybe the prices are going up there, but I don't believe the salaries are going up to that level. We all know people who are working, the salaries aren't there. People are spending 40, 50% of their earnings to pay for their residential.
Well, in addition to the crowd Bob just outlined, we're getting flight capital now, which is just coming over merely for capital preservation and isn't really counting on a return. So when you get that kind of capital in the market, you get pricing that just gets, off the wall.
Well, here's the question. We have heard from our mayor that he wants to build affordable housing. And, if you have affordable housing, and I do know that Toll Brothers, on this deal that we had spoken about on First Avenue, is building affordable condominiums as a portion of that so they can get the tax benefits over there to reduce, like a 421A approach. How many people who are developers are going to be, who have, as Toll Brothers is a public company, it's a different case. They're a different manner. A traditional developer, I don't believe they're really going to be able to build these affordable apartments, and if we don't have taxes, that's why we can't do any residential rental apartments, because taxes represent close to 27% of the rental income.
Michael, it all depends what the incentives are for the private sector. The mayor has said that he believes in increasing density, which is one thing you have to do, But what are the metrics by which he's going to implement this policy? There's been a lot of talk on a macro level, but very little granular explanation of what the incentives are going to be. If the incentives are appropriate, you will have the private sector build all the affordable units you need. But if the incentives are not appropriate, the private sector won't act.
And where do you see I mean, we've seen the price increases in certain, I mean, especially in downtown Brooklyn. I mean, no one would ever believe that the Junior site or other sites in that section of downtown Brooklyn would have they traded a year and a half ago for $150 a foot. We're now talking $350 to $400 a foot. That's 1 year. Williamsburg sites, people were paying $80 a foot. Now we're probably talking close to $300 a foot. Bushwick, where do we stand in Bushwick?
Well, I think you'll see, Michael, the Junior site is likely to trade well in excess of $400 a foot, and will set a record for Brooklyn. But I think that if you look at all the different property types, land is clearly rallying much more and has appreciated to a greater extent than any other property type. High-end retail has also had a tremendous appreciation rate, but land always leads the pack in terms of price appreciation, and that's exactly what we're seeing. We're seeing in the last 3 years in some areas of Manhattan, land has doubled, tripled, and quadrupled in some areas, which is just unbelievable given that underlying fundamentals have increased by maybe 15 or 20% over that period. So that's a huge disconnect that has to be rationalized somehow.
What happens if we have, do you see this new Midtown zoning, is that going to have an effect on prices?
I don't think so, because I think it's still confined to 20,000 square foot minimum sites. So you're not going to get a lot of deals done if you keep the requirement that large. I'm not sure why they're not allowing smaller side street buildings to be replaced, but it's not on the table yet.
Yeah, it really depends how that's implemented. As it was drafted the last time around, and the new iteration of it, it's not really going to create a lot of activity.
Do we see this type of price appreciation in Upper Manhattan, in the Bronx, and through, we hear it in Brooklyn, we see that, but I'm talking about the other markets. Do you see that in your sales today?
Definitely Bronx has gone from 6.5, 7 up to what, 9, 10, 11 now?
Correct,
In a lot of
yeah.
cases.
Yeah,
Upper Manhattan up to 15 times, maybe even more.
You know, and those markets are going to be more impacted by interest rates. And if you look at all, what's keeping interest rates low today and what those drivers are, I don't see them changing anytime soon.
Yeah, and Michael, those markets, the markets outside of prime Manhattan are the ones that are going to be most impacted by the new rent guidelines board increases of 1%.
So that's a good point. As we were saying prior to the show, what effect did the guidelines have on, did investment sales die that it went to 1%? Or is it the same thing, or it hasn't had any impact?
I think anybody who's buying the rent stabilized model where you're looking for turnover, you're not getting your big pop from the mandated guidelines increase. And that was, nobody's business model was built on that. It was all about, creating the turnover where you're taking a rent from $900 and doing your renovations and re-tenanting and moving it up to 25 or something like that. So you have a little bit of a psychological impact that was already priced in the market 90 days ago, because de Blasio has been very open about what he wants to be. And I think all of us were probably shocked that we even got a 1%.
Peter, Michael, excuse me one second. I agree with what you said, but I think that dynamic is much more prevalent in Manhattan, where in the outer boroughs, you're not taking an apartment from 800 and going to 2,500. And I think owners in the outer boroughs are much more sensitive to what that increase is. And when you have an increase that is so far below the rate at which expenses are rising and so far below the rate of inflation, you're likely to see a deterioration of the quality of the housing stock, because investment isn't going to be as robust as it would be otherwise. I think that policy isn't impacting Manhattan owners all that much. But in the outer boroughs, I think it's going to have a tremendously negative effect on the quality of the housing stock.
We've seen that movie before.
Yes.
You and I were talking prior to the show about what has happened to B pluses or B buildings in Lower Manhattan, which we didn't expect. Like the Broadway properties, which were owned by Blanco and Chomley, and some of these other buildings. These were $200 a square foot. We're talking that they're trading for $400, $450 a foot. And at that price, those aren't inexpensive rents if somebody's buying it at that price. They can't keep a $30 a square foot rent, right?
Yeah, no, it's all based upon anticipated rent growth, and we project 40% rent growth over the next 5 years. And it's getting priced into the underwriting today. And as a relative, on a price per foot basis, it's still a $450 valuation, per square foot valuation is still a relative discount to the majority of the rest of Manhattan. And downtown Manhattan is only getting better. A lot of the Class B stock to which you referred to, that is vintage stock, is being removed from the market and converted to higher and better uses like residential and hotel, and improving the overall environment of the downtown neighborhood, thereby providing the additional ability to push rents because it's just a better office environment overall.
And things are finally getting cleaned up down there, and the transit hub is done,
and it's really economics 101. I mean, if you have demand that far exceeds...
The Wharton graduate over here
If
with
you have
economics
demand that
101.
exceeds supply by such a great extent, and you layer on these extraordinarily low interest rates, you're going to have this wild appreciation.
We do remember that interest rates go higher. And, there'll be a change. The Fed has been artificially holding these rates over there. And as a banker or as a lender, when you have to refinance in 5 years, and if you've had interest only or amortization over there, there's a difficulty. And that's what happened in 2008. Crises and other situation, it's underwriting. We have a CMBS market who is back to the inflated level that we had before. We're in this situation over there again. We have more hotels being built in areas that you never expected.
But I think you have to look at the economy and say, are we really that much better off? I mean, Manhattan's doing well, but look at the rest of the country. People's take-home pay hasn't changed really in 5 years.
It's actually negative on an inflation-adjusted basis.
Yeah, it's negative.
Incomes are negative.
And you look at the first quarter GDP is 3 times worse than everyone thought it was supposed to be. So, when are you going to have wage growth that'll maybe kick in a little of inflation? And until you really have that dynamic.
And you know what? And 54.5 million visitors come here, but a good portion of them are from America also. And if they come here and they don't have increased usable money, they can't spend the money at the restaurants. They can't spend the money at the retail. And, retail today, when we're talking about retail rents at the highest levels, I was walking on Fifth Avenue today. Nobody ever thought that Fifth Avenue and 46th Street would be renting at $700 a foot, $800 a foot, But if I walk to First Avenue or Third Avenue, I got plenty of vacant stores. I got lots of vacant stores, and the world isn't that pretty all over. It's neighborhood centric over here.
And Michael, you asked how long this is going to last, and you talk about interest rates, and I do remember when mortgage rates were 12 and 13%. But how long this market is going to last is dependent upon what happens with interest rates, because the low interest rate environment has been rocket fuel for this market and is one of the main reasons why values have gotten where they've gotten.
But
so
the prices,
when are rates going to rise?
But the prices, the land prices, the apartment prices have reached record levels, okay? We've seen office buildings. I mean, as I said earlier on the show, Alan Rose, when he bought the EMY building in Times Square, he never thought he'd see his money back. The people who own 450 Park Avenue never thought they'd see the money back over there into these prices. This is, it's a phenomenon. It's a wonderful phenomenon, but you know what? You got to look at different things, and close enough, as Peter said before, Westchester has not improved. New Jersey has really not improved. Long Island is a nightmare. I mean, the taxes in Nassau County are just outrageous.
Well, that's the irony, is that, And
how far is that?
But the last downturn occurred because things got bad, and we're kind of the unintended, Manhattan and New York real estate is kind of the unintended beneficiary of all this stimulus. This has been an asset-based recovery. And, what we're talking about with interest rates is when things start to get good again for the rest of the country is when rates may rise, and that's, kind of the irony of the paradigm that's happening.
The interesting thing is how is office space being used today, and who is using it? Traditionally, the New York office environment was populated by the financial services industries.
Financial services are there.
Financial services was approximately 50% of your space using office user. Today, it's closer to 26% and has been backfilled by a more diversified base of office users across a number of different sectors, including technology, media, advertising, healthcare, and biotech. So it really has diversified and taken some of the risk out of the market with respect to how office space is being
But
used.
office space, in addition to what you're saying, office space is people, law firms or other people, they're more efficient. It's open space today. People want to work in open space. They work per cubicle. WeWorks is over there. It's a different world.
It is, and
Over here, I walked into a law firm recently. I walked into, People's United relocated to 250 Park Avenue. I went upstairs. Open ceilings. It's a different world today.
the financial services
efficiency.
industries are using space differently, and really it was
There's
a
no law
function,
libraries anymore.
It was a function of trying to squeeze profitability out of the downturn in the market, where they shrunk their office using space into a more confined environment.
Very interesting thing when you talk about that. I remember I was doing consulting for Ernst & Young, and they were at the World Financial Center, which is Brookfield Place today. Nobody had offices. We hoteled. You came in, you brought your computer, you sat you dialed in a number, and that's where it was, the hoteling. But hoteling has stopped. People want them to be more specific office space today. We don't have that hoteling.
What we expect, however, is that as job growth starts to improve and as employment starts to grow, is because it's so confined that the health of the market in the office using environment will spring back to health a little bit more quickly, because there is no current expansion space for any of these firms. So there'll be a quicker take-up of some of the Class A office space that you're seeing along 6th Avenue and 3rd Avenue that is not necessarily being used by the hedge funds and the private wealth funds that are really housed in the trophy buildings within the Plaza District.
Here's a question. Genting at Aqueduct Racetrack is doing fantastic. And there was discussions, of a convention center or other properties over there because of the situation. Have you seen any interest by investors in the Jamaica, the Ozone Park, that type of market, or as I was bringing up earlier today, the Coney Island market in different areas?
Well, our Queens office is seeing a lot of demand for investments in those areas, but you look at some of these areas, a lot of their strength has to do with their proximity to public transportation, infrastructure that exists or doesn't exist in some cases in these areas. But clearly there's demand for the entire New York metro area.
Even Coney Island?
Absolutely.
Boy. And
I think right now in the market, you're seeing people move up the risk spectrum, and they're going to areas. People are always like on the forefront trying to find the next emerging, and that's why you're seeing some of that interest in those areas.
I mean,
today.
my apples are near you. Everybody says to me, what's the next neighborhood? I said, I wish I knew. But unfortunately, I don't. And unfortunately, 30 minutes have passed by, and we really can't continue. But I think in a couple of months, I will have all of you back to see how high can they go.
Stay tuned.
Okay, and I'd like to thank Peter, Glenn, Peter, and Bob, and I'll see you next week.